Today, we're starting our journey of learning accounting with the first step of the 9-step accounting cycle, analyzing business transactions. There are a few ways accountants analyze business transactions, and one is by using the accounting equation. That's what we'll focus on today. Accountants need to be quite organized, and just like you organize yourself when solving a puzzle, like sorting the corner, outer, and center pieces, perhaps even by color, accountants use a step-by-step process called the 9-step accounting cycle to complete all accounting work from beginning to end. The accounting cycle ensures businesses accurately record and summarize their financial activities. It all begins with step 1, analyzing business transactions. And speaking of business transactions, are you wondering what counts as a business transaction? It is any financial event that impacts a company's resources. However, not every event is recorded in accounting. There are specific requirements. We only record transactions that can be measured in US dollars and those that change the resources or financial interests of the business. Said another way, we record only those transactions that change what the company owns, what it owes, what it earns, and what it spends. And that's what you'll learn. Determine if a business transaction is worthy of being recorded by the accountant and how to record it in the financial records of the company. We'll start slow, and at the beginning of our analysis, we will use a simplified version of the fundamental accounting equation. Property equals financial interest. The simplified accounting equation basically states that the property of the company is equal to the financial interest in the business. Let's say that the owner of the company puts $1,000 into the business to be repaid later. The business now has $1,000. It's the business's property. But at the same time, it still owes $1,000 to the owner. And here we're already covering another accounting concept. Every business transaction involves at least two parts. Later, we will call that a debit and a credit, but for now, we'll only talk about increases and decreases. But let's clarify what is property and what is financial interest. Property includes things like cash, equipment, supplies, building, land, prepaid expenses, monies owed by the customers called accounts receivable, and inventory. In short, property that the company owns. Financial interests and obligations are monies owed by the business to either third parties, such as monies owed to suppliers called accounts payable, bank loans, notes payable, monies received in advance from customers, but also monies owed to the owners of the business. When accountants record transactions, they might impact both the property and the financial interest, meaning that both sides increase or decrease, whereas other transactions might increase one property category and decrease another property category. Or yet another transaction might increase one financial interest category and decrease another financial interest category. Lots of possibilities. After every transaction, though, the equation must still be true. Property equals financial interest. Most students learn accounting concepts best with step-by-step examples. We'll use the case study of Eli's Consulting Services. Let me tell you a little bit about Eli and his business. Eli's Consulting is a service business and provides a wide range of accounting and consulting services. The owner of the business is Trayton Eli, who is a CPA and has a master's in accounting. The business also has an office manager, Sergio Sanchez. The office manager has an associate's degree in business and has taken 12 semester hours of accounting. Every month, Eli's Consulting Services bills clients for the accounting and consulting services provided that month. And customers can pay in cash when the services are rendered or receive credit. You'll learn more about that later. Most businesses need startup capital to pay the initial expenses of the business before customers start paying for the services. To start his business, Trayton took money from his personal checking account of $100,000 and opened a checking account in the name of Eli's Consulting Services. Why do you think Trayton opened a new checking account? Well, the separate bank account helps Eli keep his financial interest in the business separate from his personal funds. The $100,000 transaction is the very first business transaction, and we need to figure out what to do with it and identify how it affects the equation. Property equals financial interest. Are you ready to record the first business transaction for Eli's Consulting? Just remember that not every business event is recorded. For instance, if the marketing team creates a new marketing campaign, the accounting team probably wants to know about it, but that would be a business event that is not yet recorded. Why? We only record transactions that can be measured in US dollars and change the resources and financial interest of the organization. There is an additional requirement, which is that you need supporting documentation, meaning proof for every transaction. But let's start with the basics. There are two major steps to analyze the business transactions. First, we describe the financial event by identifying the property that is impacted. In our case, the business received $100,000 in cash. Okay, remember every transaction has two parts. So for the second part, we identify who owns the property, who has the financial interest. For this transaction, Eli has a $100,000 financial interest in the business. Next, we determine the amount of increase or decrease. The business now has $100,000 more cash, and Eli now has a $100,000 interest in the business. That means that property increased and the financial interest or obligation side increased as well. We'll start by adding the category cash to the property side and the capital account for Trayton Eli to the financial interest side. That helps us keep things organized. So let's enter the transaction of $100,000 into our table and calculate the new balance. The second step is to make sure the equation is in balance. Let's double check that. $100,000 in property equals the $100,000 in financial interest. And we did it. It balances. And we analyzed our first business transaction for Eli's Consulting. In the second business transaction, Eli's Consulting issued a $5,000 check to purchase a computer and other equipment. That makes sense, right? He needs the right equipment to service customers. So let's analyze it. The firm purchased new property equipment, which means that the property side of our equation increased. That's part one of our analysis. But remember, every transaction has two parts. In part two, we figure out the financial interest aspect. The firm paid out $5,000 in cash, which means that the property of the business decreased. To keep things organized, we'll add another category on the property side for equipment and write plus $5,000 in the equipment column and write minus $5,000 in the cash column. Does our equation still balance? Let's calculate our new balance. $95,000 in cash and $5,000 in equipment equals a total of $100,000 in property. And the financial interest side shows $100,000 as well. So does it balance? Yes, it does. For our third transaction, we have the following business event. Eli's Consulting purchased office equipment on account from Office Plus for $6,000. Buying on account or on credit means that you don't pay the full amount right now. It means that you promise to pay the amount at a specific date in the future. However, we have to keep track of the amount owed and the equipment purchased. Let's analyze the transaction. Eli's Consulting purchased new property equipment for $6,000, which means that the property side of the equation increased. That's part one of the analysis. Let's look at part two. Eli's Consulting now owes $6,000 to Office Plus, which means that the financial interest side of the equation increased. We'll add another category for accounts payable on the financial interest side and write plus $6,000 in the accounts payable column and write plus $6,000 in the equipment column. Let's calculate our new balance. $95,000 in cash and $11,000 in equipment equals a total of $106,000 in property. And the financial interest side shows accounts payable of $6,000 and capital of $100,000 for a total of $106,000 of financial interest. So do both sides of the equation balance? Yes, they do. Let's look at the fourth transaction. Remember, Trade and Eli hired office manager Sergio Sanchez? Well, Sergio purchased office supplies, and Eli's Consulting Services issued a check for $1,500 to Office Deluxe Inc. to purchase office supplies. So let's analyze this business event. The company's cash decreased because Eli's Consulting issued a check, and the company now has more office supplies. So let's write that into our table. We'll add an additional column for supplies to keep things organized and separate, and add $1,500 in that column. And for the second part of this transaction, we'll subtract $1,500 from cash. The new cash balance is now $93,500, and when we add up all the property accounts, cash, supplies, and equipment, the sum is $106,000, which is the same total amount for the financial interest accounts. Can you believe it? The equation still balances. Let's continue with the fifth transaction. The office manager Sanchez pays $2,500 to Office Plus to reduce the firm's debt. This related to our third transaction when Eli's Consulting bought computer equipment on account from Office Plus for $6,000. When we analyze that original transaction, we increased computer equipment and we increased accounts payable. Now that Sanchez pays part of the $6,000 that Eli's Consulting owes Office Plus, we need to figure out what to do with this business event. First, we need to reduce the accounts payable account because Eli's Consulting now owes less money to Office Plus. For the second part of this transaction, we need to reduce the cash account because Eli's Consulting now has less cash. So we deduct $2,500 from cash and we deduct $2,500 from accounts payable. What do we do next? That's right, let's check our equation that our equation still balances. We add up $91,000 for cash, $1,500 in supplies, and $11,000 in equipment for a total of $103,500. And on the financial interest side of the equation, we also have $103,500. So our equation still is in balance. The sixth transaction occurs when Eli's Consulting rents office space. The landlord required that rent for the first 2 months, December and January, for a total of $8,000 be paid in advance. That's not uncommon. Quite often, commercial property landlords will want a deposit and several months of rent paid in advance. Now, there are special accounting rules when it comes to expenses that are paid in advance. In accounting, this prepayment is considered a form of property, because the business could get a refund potentially if it did not use the facilities the entire time. So what do we need to do when Eli's Consulting issues a check for $8,000 to pay for rent for the month of December and January? Let's break it into part 1 and 2. First, the business now has a new property account called prepaid rent. We'll add that to the property side of the equation and add $8,000 into that column. For part two, we need to also reduce cash by $8,000. So let's write minus $8,000 into the cash column. And let's double check that our equation still balances. Cash, supplies, prepaid rent, and equipment total $103,500. And so does the financial interest side of the equation, which means that we still balance. The table we've been using provides us with a lot of information already, such as how much cash is available, how much the company owns in terms of supplies, prepaid rent, and equipment, and how much the company owes to others. Another way to use this information is to prepare financial statements that external and internal users can readily understand. Why not use this table for external and internal users? Well, a standardized format is much easier to understand and compare. Let's see what that looks like. We can prepare our first financial statement, the balance sheet, by listing all property accounts in the column called assets. Assets is a standard word used to describe the property the company owns. On the other side of the balance sheet, we differentiate whether the money is owed to third parties or the owner. So we list the accounts payable as liabilities and the amount owed to Trade and Eli under the description owner's equity. The balance sheet shows the firm's financial position on a given day. In our example, Eli's Consulting Services prepared the balance sheet as of November 30th. On the asset side, we have cash of $83,000, supplies of $1,500, prepaid rent $8,000, and equipment of $11,000 for a total of $103,500 in total assets. On the other side, we have liabilities of $3,500 and owner's equity of $100,000 for a total of $103,500. And that, voila, brings us to what we call the balance sheet or the fundamental accounting equation: assets equals liabilities plus owner's equity. Want to analyze more business transactions for Eli's Consulting with the help of the accounting equation? Go ahead and watch part 2.